Is the best part of the summer rally behind us? Well, the answer to that is no. Has the trend changed? Well, answer is yes and no. Because a week ago, traders were chasing stocks. They were ready to buy stocks on every decline. I guess after today's crunching blow, traders may not be chasing stocks, but there is a lot of quality which is available now. A lot of mid-cap stocks have corrected. HDFC, Sun Pharma, quality names are still holding on. So what you want to do is really cherry pick from the quality space. Stocks which you always wanted to buy, maybe next 1 week or 10 days you will get enough reason to add on to your positions or really to load up some of those quality stocks. But today we've got a full house for you. Technical experts are of the view that today's rally was trend changing in nature and it is clearly advantage bears now. Fundamental market watchers are of the view that more than local factors, watch out for global factors. So let me introduce my power-packed panel today. BP Singh of Pramerica Mutual Fund, Vikas Khemani, Edelweiss Securities, Vijay Bambani, author and Chief Executive Officer of BSPL India, and we've got a voice from the House of Ashmore Investments, Jan Dender. Gentlemen, good evening to all of you. Thank you for joining us. Mr. Singh, let me kickstart the discussion with you. The big question which is occupying everyone's mind is that is the best part of the summer rally behind us, and do you think it is difficult to sugarcoat today's price action?
Hi, good evening. Don't you think the same query actually was there in everybody's mind since the start of the year? Now, whenever you have a market which is driven by liquidity, the global liquidity, the amount of confidence which investors have in that particular market will continue to be questioned at every point in time. And any event will always be actually a reason for people to find out whether to look this way or other. Now, as we have been pointing out in the past that what rally we are witnessing in India is not the structural rally, it's more of a cyclical gain which we are witnessing. Please note that today what actually the global market got actually disappointed with was the slowdown in China, the numbers which came out from China, which actually are good news because the commodity prices worldwide are going to correct on this particular news, which will actually benefit us. However, the market in the short to medium term are being driven by the liquidity, and so therefore any news, even interpretation of a news will actually make people react to it. And so these are some of the news which got clubbed together. What people will have to keep in mind that these kind of scenarios, they will continue to result in highly volatile market, and investors will have to just continue to focus for the quality stocks and continue to have faith in the underlying fundamentals, and the markets will deliver.
Okay, keep the faith, says Mr. Singh. Vikas, let me bring it to you. You know, a lot of problems have bunched up all together. You've got the rupee, there's global liquidity, comments that are coming in from central banks. How are you assessing the situation?
I think, as you just summarized well, that I think we had a great global equities rally in the recent past, and I think we have seen Japanese yield going up in the last 1 week steeply, and the comments from the central banks, and I think currency impact has sort of led to this correction. I think the sharp fall in Japanese market on Nikkei, I think, has also kind of had rubbed off all other markets. So I guess it is, I would look at it in that line, the correction. As far as the Indian markets are concerned, I guess we have a case for interest rate going down. That continues, that will not change. The only thing I think we will have to worry about is that where does rupee stop and what kind of implication it would have. But looks, I mean, I would not at this point in time sort of expect that rupee will slide significantly from here on, but one needs to see how the global markets react and what kind of flow comes through. We have a couple of large sizable flows also lined up for us in next 1 or 2 months. So I think that should, in my opinion, sort of provide some amount of comfort and in settling down the rupee somewhere around here. But one has to really wait and watch and see how it pans out. But it looks like that I think our interest rates sort of coming down scenario will continue. Result season is by and large sort of getting over, and results have been by and large all right without any significant disappointments. So I think things are, in my opinion, this correction, I would look at it as more sort of in temporary nature, given the given the current recent rally and the global corrections. And I think it should settle down soon, but I don't know, frankly speaking, what level it will settle, because when it comes to the sort of liquidity, one doesn't know. So far, we haven't seen any institutional investor panicking out, any institutional investor changing the view in the recent past. You will always have some trading views being taken by the investors. That cannot be stopped. But from a fundamental perspective, I haven't seen any investors panicking out or changing the view on the India story at this point in time.
Vijay, how would you dissect today's market action? Do you think today's market action in Indian equities was more like a trend-changing market action? The scales have shifted and it is clearly advantage bears now?
If you are a trader, Nikunj, I think the bears are ruling the roost. And by trader, I mean anything from an intraday trader to maybe a trader who takes positions for a few trading sessions. Equilibrium in the market is now being sought by prices at lower levels. So short-term traders, leveraged players, futures traders will seek short selling opportunities. On the other hand, if you're a delivery-based investor who doesn't really bother about 10 to 12% decline in the overall markets, I don't think the longer-term trend has changed. I was just looking at the monthly charts before you came to me, and on a very long-term basis, I think the current scenario seems a whole lot better than the peak that we reached in November of 2010. So unfortunately, going into a new high will not really take place today or tomorrow or day after. You'll have to wait for probably a couple of months, if not 1 or 2 quarters maybe. But I think for delivery-based investors, there's nothing to worry about. The long-term trend still remains in place. It's only for the next couple of weeks or max next couple of months that the waters have been muddied for traders. But traders know how to survive. They know how to change their direction of trading. And I think in the next couple of days, it'll be shorting.
Yeah, and let me bring it to you. Do you see merit in fears that seem to be emerging within global markets on this abrupt QE exit by the Fed?
I think the idea of an abrupt exit from quantitative easing by the US Fed is a pipe dream. It's extremely unlikely to happen for a number of reasons. First of all, the debt levels in developed economies are way, way too high that a sort of rapid normalization of monetary policy would be economically feasible. In fact, a very rapid exit from monetary easing would probably create very large negative wealth effects in developed market fixed income portfolios, which in turn would plunge the economy straight back into recession. What we have ahead of us is essentially that the developed economies need to engineer a period of inflation to erode the real value of their debt down to a more manageable size. And once it's sufficiently small, then they can raise interest rates and then kill inflation. But remember, we haven't even got inflation yet. So we're very far away from any notion of a dramatic tightening of monetary policy in the United States.
Mr. Singh, I want to ask you this then. What is it that you are expecting from the Fed? And, do you also suppose that global markets could have read a lot more than what Ben Bernanke was hoping to convey?
Yeah, that's true. I mean, what he was telling, he was actually indicating some of the landmarks where if milestones where if they reach, then that will result in them, they're looking at somewhere trying to curtail the purchase. Now, we need to understand that those landmarks are yet to be reached, like 2.5% inflation. And that's something which is not very easy in the current scenario. Similarly, if you look at what European, like Mr. Draghi said last time, or what Japan is now targeting, both of them are targeting a certain kind of inflation levels, which are at this point in time are not look very realistic in the near scenario. So yes, those are the guidelines in which they are operating, but those guidelines are those parameters are not easy to achieve in the current scenario, and we expect it may not be easy for one particular entity, like for example United States, to suddenly start withdrawing the liquidity when the others like Europe and Japan are still pumping in liquidity into the system. So I think it will be a more planned and structured way in which these entities will have to come together and work on it. It's not going to happen so abruptly.
But Vikas, so if you are of the view that one should use today's decline to their advantage? Where are you buyer in this market, and what exactly are you looking at accumulating on every decline?
See, I would, as I said, that it clearly depends on what is your time horizon, because I think as you said that we have macros have sort of, as far as India is concerned, are falling in place. I think we have a significant political event ahead of us, so one has to take positions or make sort of investments only keeping that in mind. And I continue to maintain that I think markets will continue to remain volatile till the time that event is behind. And I think one will not be able to sort of go all out in the market and saying that unless you have a 3 to 4 year or long-term horizon in the market. From a short-term perspective, market will be volatile, and such kind of news flow will always sort of create a high amount of panic in the market. So one has to, if one is ready to live with the short-term volatility, I would say that dips could be the opportunity to buy. The time horizon has to be medium to long-term.
Right, Vijay. If your view is that in the near term it is advantage bears, identify some stocks for us where traders can make a quick buck by going short.
Nikunj, real estate, the frontline counters like DLF, there are some pressure points in banks. Take, for example, Bank of India. I don't really mind shorting provided I get 309, 310 odd levels tomorrow. I'd hold that with a stop loss at 313 odd levels. I think it'll seek equilibrium close to 302 levels where I'd like to extinguish my shorts. Reliance Infra is another stock which I think merits shorting if I get marginally higher levels of 369 or 70. I would hold these shorts with a stop loss at 374 levels. I think I can basically try and attempt to square up these shorts at 360, 362 levels. SBI is another counter which is looking weak. So if in the future space, if I was to get the May futures at marginally higher levels of 2,145 levels, I don't really mind shorting. I'm targeting a higher level here deliberately because after a huge down day today, sorry, I do expect a marginal pullback, and I'd use this pullback to short at 2,145. I'd hold these shorts at a stop loss of 2,166, and I would expect to book profits close to 2,115 odd levels.
Jan, let me bring it to you. What's your outlook as far as India goes? You think it's a good time then to start buying Indian equities?
Yeah, India is of course a super interesting story. The Indian government has done the right thing on fiscal policy. The central bank is maintaining a very vigilant and responsible stance, in my opinion. The government has done some reforms, which is very positive, and we're likely to begin to see the fruits of this. Of these measures begin to kick in the second half of this year. We also are in an environment right now where oil prices and gold prices have dropped significantly, which is quite good for the external balances in India. So all of these factors, and of course with the external balances improving, you also have less pass-through to inflation coming from the import side. So all of these factors are really coming together to allow the central bank to gradually ease policy. And as the measures that have been taken already, the fiscal measures begin to fade over the course of the summer, and as the reform efforts that have been done begin to spill into slightly better growth in the second half of the year, I think we are currently in the process of setting a really good base for quite a strong pickup in equities in the second half of the year.
Mr. Singh, let's talk about specific sectors. Given what we are seeing with the rupee at this point in time, do you suppose that we will see the IT pack outshine, and how would you play the IT counters?
Well, we are now positive on IT sector since last a month when the valuations have corrected, and it's purely because of the valuations which is actually making it attractive, as the rest other sectors were very costly. Now rupee depreciation is definitely a benefit, and looking at the current account situation and the global liquidity condition, I think a soft rupee is a very likely scenario which is obviously going to benefit this particular sector. So we are quite positive on this particular sector. In fact, we like most of the sectors who are going to benefit because of the currency depreciation, and so pharma also is one sector where we are quite positive on.
Right, so Mr. Singh, if you are bullish on dollar, which means you are bearish on rupee, so does that mean you are also bearish on commodity companies?
Yes, which I mentioned initially, that the commodity stocks, if you see, are not only correcting, the commodity as such will continue to correct. In fact, what happens when the slowdown, and if you see the global manufacturing indexes are actually now below 50, what it means is that there is some amount of contraction in the manufacturing activity taking place. So commodity prices from here are likely to continue to remain subdued. Another impact it will have that people start selling forward in advance, and which has a major impact on the commodity prices. So which we are very positive on the stock point of view, and that actually makes us quite very confident about the India story, because the falling commodity prices provides much more breathing space to the planners to help us to improve the structural problems which we are facing currently.
Jan, what's your outlook on the rupee? You know, for the last couple of days, it's showing a fair amount of weakness.
Well, the rupee has held up quite well. It's displaying essentially the same kind of volatility that a lot of other currencies are displaying. Currencies are kind of locked in a strange sort of frozen state with not a lot of trend and relatively high levels of volatility. This is essentially because of the global macroeconomic environment, and I think this environment is going to remain with us for a period of time yet. So I don't have hugely strong directional views on the Indian rupee. I would not sort of advocate a strong view either way. What I will say, though, is that if you look slightly further into the future, inflation is going to be a real issue in those countries that are printing a lot of money. And when that inflation begins to manifest itself, it will have a negative impact on their currencies. And we're really talking about a major global currency realignment that's sort of building up and will manifest itself over the next couple of years. And that currency realignment will be strongly positive for the Indian rupee.
Right. Vijay, final take from you. 60 to 50 has been a big, stubborn resistance for Indian equities. Do you think it will remain as a stubborn resistance for the rest of the year as well?
I'm not really sure whether it will remain as a stubborn resistance for the rest of the year, but at least for the next coming few months, yes, the markets might attempt to head towards that ceiling and retrace from there. The chances of this ceiling holding for the rest of the year, from my point of view, is 50-50 at best.
All right, gentlemen, many thanks for taking time out and sharing your viewpoint with us right here on this edition of Market Hour. Time then for a break. Up next.